Hey, welcome back. A little fun hour session. It's about 3:27. I just had a couple meetings run long, so sorry for the late start. But thumbnail today, I think this is a pretty important question to be asking ourselves, in the U.S. and abroad. Will the U.S. grow or print its way to prosperity? Um, I think that the actions we are seeing, we have a very active administration under Trump. Whether these deals, as far as like getting Japan in line last week in the Eurozone right now, and then we have it's ongoing back and forth with China, AI arms race, CapEx spending, infrastructure growth, building out AI data centers, you name it. Nothing is going to come cheap. And this is probably one of those environments where you have to make money or spend money to make money. Um, I think that there are some obvious headwinds when it comes to bottlenecking the speed and exponential growth that AI in the future kind of look like. But also the reality is, what do we do when everything is more expensive? What do we do when the consumer is being stretched? When businesses are struggling to see any path to refinancing and cost effective debt restructuring? Because the answer is you don't really pay off debt, you refinance debt. And this is where the big liquidity air pocket and the refinancing pocket comes to fruition in the next couple of months. So we'll see. I think that we've heard some adjustments where the Fed trying to stay with this like 2 to 3% inflation target or 2% inflation target and just being well above it and holding rates and holding rates and holding rates. At this point is kind of a critical pivot where the Fed also might be hurting growth and hurting the this near term need to grow fast and grow as fast as possible. This is where kind of the world is looking. I think the U.S. can be and probably should be like a trailblazer as far as like setting up uh, the global economy for success, and then having other countries fall in line and benefit from it. But it'd be nice to see that the whole world can benefit as opposed to it's all us or it's all non-US. It's us versus them. I think at the end of the day, if the global economy is going to get lifted, the U.S. is going to be a big part of it. You can't have the full party without the U.S. being invited. But we also don't want to isolate ourselves and having like America only. America first is fine. America on its own little island with no friends or people showing up to the party is not a good thing. So I think right now the focus is we're growing. We want to grow. We're trying to grow quickly. How do we do it? I mean, deregulation, fiscal policy, hopefully an accommodative Fed in the next 12 or 24 months. There's all sorts of arguments on how the Fed's backed into a corner. We're clearly seeing a lot of pressure between Trump and Powell. We have a little taste of that coming on Wednesday with FOMC. Does Powell address some of the questions and concerns about him being replaced or resigning or pressure from Trump? Yes, no, maybe so. Usually he takes the high road and doesn't really talk about stuff like that. He doesn't address things like that. But you never know. I mean, if he, again, I don't think Powell's the type of guy that's going to go off script. But in the Q&A sections, if he just basically says what he wants to say, if there's like anything off the cuff, then we might see some price reaction this week. So in the near term, as I've said, with a lot of sessions this morning, expect some volatility this week. All right. I mean, seriously, there's going to be 790 companies reporting earnings with Mag 7 included. We got major market cap up for grabs. We got the Fed on the 30th, which is Wednesday. You wrap up the month on Thursday, the 31st. You have non-farm payroll and a trade tariff deadline on Friday. I've said this earlier this morning. I don't think the tariff deadline means as much as it would have meant maybe 3-4 weeks ago. Reason why is Japan came to the narrative last week as far as looking at a deal with the U.S. and Eurozone. Same thing. I saw that happen last night. I'm like, well, I'm expecting the futures market to at least be solid and stable. In my daily profit play this morning, I told traders until I see the correction that I want. And to me, that correction, and I mean, it's nothing crazy. Like I'm talking about a correction that may be back down to the 21 or the 50 period moving average. It's nothing wild. We're talking about a correction that gets us here or here, right? And if that's like leg one and then there's more to it, then maybe down in here and the market can kind of settle in and then get bullish again into the end of the year. So a little ventilation goes a long way. Even if we went down and up and down and up and it just went sideways for, let's say, 30 to 60 days, I still think this market tries to grind higher into the end of the year. Right. There are a lot of analysts that are changing their targets now. I think we're seeing a lot more forecasts calling for the S&P to be at the 67, 68, 69, even 7,000 plus targets by the end of the year. Whether you predict that or not, I'll give you the options market forecast. How's that? I think that's actually more accurate than an investment bank. Okay, so based on current volatility, let's see what SPX can get us to by the end of the year. Current volatility, we got an IV rank of 12.3. We have the VIX around 15 and change, 15.41. VIX is a little choppy today. I think the VIX is going to make a spike up here in the next maybe 30 to 60 days. Not to a ton. I'd say maybe we capped out at 25 or 30 if we have the market pull back a little bit and that volatility gets faded. Let me check one thing here on the SPX. So coming into this morning's trading, consolidating, a little bit of a breakdown there. Yeah, that's not too bad. All right. Anyway, just looking to short some stuff. So here's VIX. Let's go to the options chain. And if volatility changes, so too does the forecast. But if we just go out right now to the end of the year, let's go to December 31st on SPX, and within reason, this expected move to the upside to about a 23 delta is around 68.75. So if we let the options market kind of call the expected move, obviously there could be like some slight upside bias, right? I mean, the market's just been melt up. But low volatility, the melt up, usually it's bulls climb stairs. If the market dips and pulls back, then we have the expected move maybe widen. If anybody uses probability cones, that area probably widens a little bit. But this is looking for possibly the 6850 to 6900 end of year target, give or take on that expected move to the upside. So what does that mean? Well, we could certainly stretch to 6900. We could stretch to 7100. We could stretch to, let's say between 69 and maybe 7100, which is around a 12 delta. I could see markets kind of testing those levels and then pulling back to a round number like 7,000, maybe a round number like 69, maybe a round number like 68. But it shows it's within reach. Like 7,000 is a 16 delta. That's within reach. I've had plenty of trades. Believe me, I had plenty of trades at a 10 delta, 15 delta that still get tested. They may not close at those levels at expiration, but they get tested. So don't discount this market just continuing to do what it's been doing these last 30, 60 days and just melting up. And I think there's going to be some hiccups along the way. There's going to be some noise. I really think that's one thing that a trader has to block out this year is noise. I think if the destination is bigger picture bullish with an accommodative government looking to grow, be aggressive, and a Fed that's going to be a little bit more accommodative versus restrictive. I mean, this is my comment here in Telegram. This is a more important question for the U.S. 3 to 5 to 10 years away. Will the U.S. grow or print to prosperity? Decisions and actions now will determine the key to prosperity or problems. Obviously, if we struggle to have the rare earth minerals, the materials, the mining, the refining, and the corporate actions to drive these future growth prospects, I think there's ways that like this whole thing gets bottlenecked and derailed, and all of a sudden it's like, see, it's an AI bubble, or this could be a true path to prosperity. The concern would be, it's like, to what degree? To a degree of like corporations making lots of profits with high profit margins, to the degree of the S&P, being so concentrated in the top 5 or 10 stocks that that's all that matters. As long as those 5 or 10 stocks do well, the whole market goes higher, and then everything else is underperforming. Or to the degree of even small cap companies or companies that aren't even publicly listed are better in the private equity space. And have you heard about this, where it's like there's a push to make like having public money go into private equity? That's not a good thing. I don't think that's a good thing at all. I don't know. I think that's really, really risky. So it would be challenging to see the world not have companies come to market with a lean, mean operating, let's say lean, mean profit machine, right? So they don't go public. They do way more with less. They're very efficient in the AI space. Maybe this is more of a tech play, but services in general, admin in general, things, whatever is offered. And there's going to be all sorts of gap fill type companies that come in and try to serve a purpose, like a Palantir comes in and serves all these purposes, where they're kind of like the middleman. They're helping make companies more efficient. They're helping make companies better, more profitable, leaner, meaner, whatever. There could be those type of companies that come in and do a lot of good things. And there could also be companies that come in and never go public. and they, maybe are worth $500 million to a couple $1 billion. They never go public. There's never something you and I can trade. It'd have to be private equity only. And that's not obviously easy for every investor to get their hands on. So I don't know. Um, but I obviously don't want to see, you know, discouraging bottlenecks where it's like, oh my gosh, if we could just get out of our own way, if we could just let AI run rampant. It's like there's pros and cons to all this. We had a discussion today on Profit Panel about AI. And, I think right now that we're probably looking at AI in a bit of its infancy, but I don't think that people are prepared for how displaced a lot of jobs can be. I don't think people are ready for the potential threat of if we have like an all-knowing AI superpower, and it might feed us some solutions, and it might feed us lots of profits, and it might feed us this road to prosperity. But to what, like, something's going to get sacrificed. Like there's no just upside without having something bad. Like there's always pros and cons, right? There's going to be Pareto's principle. So maybe 20% of the greatest companies in the world can do 80% of the profit margins, and do 80% of the growth, and the whole market can get lifted, and there's all sorts of value for shareholders and investors. But there's still a reality. Are we doing this with just crazy amounts of energy uses? Are we doing this with, more, I don't know, just more stress on the environment? Are we doing this where we're still growing a population of people around the world that now don't have jobs? There's going to be something that's a trade-off. And if you're an investor, you don't look at stuff like that. You're like, I want to make money. What do we do to make money? And you're as greedy as, the corporations that you're trading that are trying to make as much money as possible, right? But I am a glass half full investor. I think that if we start to see this, where we have laws and regulations and policy that is supporting growth, that's a good thing, right? But it's the matter of, do we keep it in place, or do we repeal it? Right? Do we have Trump comes out leading with a really aggressive agenda. He's getting the tax bill passed. We're doing deals right now with the world. But do the midterms next year swing the other way? And all of a sudden, everything that looked good this year with some growth and momentum is all of a sudden changed. That I'd say that is a severe problem in the U.S. as far as like the 2 and 4 year political cycles, and that becomes a bottleneck for growth. So I'm hoping that government doesn't get in the way. And I don't know. I mean, I want to be optimistic, and I think we can grow our way through a lot of things. I think we can have that with the right intention, but we also have mounting debts and mounting fiscal cliffs, and there's deadlines, but maybe it gets kicked down the road more and more and more. Maybe the alternatives, maybe there's more stress in the financial markets, maybe there's too much leverage out there. So all these things could happen where you can't have X amount of leverage without having a deleveraging event. Does something happen with the Fed where they botch policy? Maybe they're not accommodative enough to an aggressive fiscal spending like we have here in the U.S. right now. And if they're not accommodated enough, then the Fed's at the risk of losing independence, because we're potentially going to have a shadow Fed, which is a replacement. Even though Powell may not step down or resign, we could have somebody that's basically, here's going to be the new Fed chair. And people know it. The market's going to sniff it out and see whether or not this is going to be just a yes person that steps into Fed chair, and how the market reacts to it will be interesting to kind of watch it unfold. But if you think about this market, like for anybody that's like a perma bear, right? Anybody that's a perma bear, number one, I don't know how you're still trading. I mean, if you've been a perma bear for the last 20 years, I don't know how you're still trading. I mean, if you want to grow, like wake up and trade every 3 to 4 years, and maybe grab a 10% correction in the markets and put all your money on those corrections, yeah, maybe you're a successful bear. Otherwise, the market grinds. The market does what it does best. There's been a bullish bias in these markets for the last nearly century. So don't fight it. It's like, it's so easy. It's so much noise, so much noise, so much chatter, so much uncertainty, so much fear. And I get it. Like it sells clicks. It drives people to take some actions. It drives people to, well, I don't know. I should just I should buy an ETF, or I should just put my money in bonds and do something at the bank, and just do something safe. I don't worry about the risk. If you're in that environment, then sure, don't take the risk. There's always risk. Like nothing's risk free. Even parking your money at a bank is not risk free. If those banks are insolvent, it's not risk free. If you have an insolvent bank at some point that doesn't get backstopped by the Fed, there's risk in that trade. And so I think the best thing we can do is, if you're a trader, if you're an investor, you should be cheering on the global economy, you know? So wishing for the US to fail so you can make money in what? China stocks? So you can make money trading the DAX, maybe? So you can make money in people that are being crazy bullish on commodities because we need this big build out. The whole market is sentiment driven too. So if we have a broader downturn in the US market, it's going to take everything with it. Some things might rise to the top that might be like the true like value to growth rotation, maybe, but value investors have been getting smoked for a while. Bears have been getting smoked forever. And I think if you want to be a long-term investor, you have to cheer on these markets. You have to be okay and be happy that, you know what, I think the S&P can go to 10,000. And it's like, and I don't know how it gets there, but I hope it gets there. And how does it get there? I don't know, in waves. So let's say the market goes 1, 2, 3, 4, 5, right? And what have I been talking about these last couple months? I think there's going to be a pullback. I think there's going to be a pullback. I think there's going to be a pullback. That's not making me a bear. It just means like, look, man, this is an overstretched market with now an official print up here where I see the same thing where we go sideways or down, overbought conditions with divergence. So price and momentum disagree on a high enough time frame. So at the very least, a 1, 2, 3. Okay. Now that might be back here towards this previous all-time high. That might get back into this area. If we have a wave 4, this is what wave 4 could be. If it's 1, 2, 3, 4, 5. I'm going to highlight this in green. Okay. This area right here is where I'd be looking to buy dips. So I don't even know if we get there. I hope that we do, for the fact I like to position a lot of my trading for that area to be like, okay, this is a great little pullback. Let's say we have somewhere between like 8 to 10%. Well, I'll take it from these current highs. This is around a 6.5% pullback. Okay, 6.5-ish, all the way down to potentially a double digit. Maybe we get to 10. So a 6 to 10% pullback to me is a great spot to be positioning long. Is the market going to fall straight down to the lows again? Probably not. If the market is going to proceed to go lower, how's it going to get there? Okay, the market would proceed to go lower like this. If we go down, let me just change this color here. If we go down and up and then down again and up and down again and up, I mean, maybe that's the case. This feels like garbage. This feels like garbage. You think you're out of the works and you're ready to buy the dip, and it maybe tests you one more time. Then it troughs out over here. Then you have a trend line break and the market works its way back up. Now, whether that is a 20% correction, or it's a 30% correction, or it's a 40% correction, or if we have a repeat of the great financial crisis, maybe it's a 50+% correction, right? So this is why protection and hedging and having a game plan with making sure that in a bear market, you're not experiencing all the gains of a bull market and all the trouble and problems of a bear market, and then you're building back again from start. This is how we grow and manage and grow and manage and grow and manage. Look, I want to make money in a bear market if I can. I'd like to make money in a bear market. That's what nimble trading is for. That's what, I keep using options as an example. That's why I like options trading. I can be nimble. I can still make income. But if I can start here, if I can put in, kind of a bulletproof portfolio where it's like I grow during good times, I don't lose during bad times, and then I grow again, that's a lot better than the trader that experiences the growth and the busts and the growth and the busts and the growth and the busts, because you can get way further ahead, right? Versus building from here and getting to the same point you just reached before, you're actually just building to fresh highs. And that is how you can compound your wealth, right? So in terms of real growth, our job is to not lose a bunch of money. It all comes back to risk. And I think it's crazy how much risk people take with no understanding of how to protect the portfolio to the downside. So a correction in my world that I'd love to see minimum is at least the 21 period or the 50 period. That's about a 2 to 5% correction. If we come back a little bit deeper, I'd be happy with that. Okay. If you look at this big thing from a fib, take a fib from this low to high. This market is going to pay attention to these things. Okay. A 30% pullback. Here's 23% here. Here's 30% right here. Okay, here's 38 to 50% here. Just on sheer pullbacks and sheer technicals, if we have a pullback to the 30% fib, it's a 30% GAN level, but I use those kind of interchangeably. So either this is a shallow retest and the market goes back up to retest highs, or this is a more efficient pullback and the market comes back to retest highs with some projections higher. The 18127 extension, that's already posting around 6,700 to 6,800 upside. Do I think that 7K is doable? Of course. Do I think that 10K is doable? Of course, right? What's going to be kind of odd to me is like, well, what if the SPY is all of a sudden $1,000 asset, right? If the SPX hits 10,000, the SPY doesn't split. We're trading at 10,000 or $1,000 in the SPY. It's going to be a little bit tougher to have SPY in my portfolio without allocating 100 grand cash. It was kind of nice over the last couple of years to have like $35,000 cash and own 100 shares and still have it now worth almost double the value. $45,000, $50,000 cash allocated, almost 30 to 40% higher. That's okay. But if we just keep grinding to 10,000 on the SPX and the SPY's at 1,000, I don't know. I mean, part of me hopes that the options market gets creative and allows us to trade like fractional options. Can you trade options instead of in 100 and 100? Everything represents one contract is 100 shares. Is there a way to get like a 50 share, like almost like a micro option? I mean, I could see that happening to allow more traders, investors to trade, especially if these assets remain high and they don't split, right? So anyway, as soon as I hear something from Trump, I'm always thinking about what comes out as a taco trade, separating noise, going, yep, noise and data, that's an important thing. James says 2-year bond market, 10-year market shows there can be a market crash by the dip. Yeah. I mean, again, using the word crash is, look, a pullback isn't a crash. I mean, look, this was the potential crash. Like that was potentially a crash. Now, where did it stop? It honestly stopped so good technically. Like it was such a good technical reading here to just see a past resistance level to become support. It was just really messy and scary how it got there. But it bottomed at a previous high, became support. We had a nice double-digit correction, almost 20% to the peak to trough, and the market ran with it and ran with it hard. So a dip, a pullback, it's not a crash. Pulling back 5 or 10% is not a crash. Pulling back 5 or 10% is a pullback. And that would look a lot like 2024. We had lots of pullbacks in 2024, right? Pullbacks in 2020. Here's a melt up in post-COVID, right? Post-COVID, hit all-time highs, pulled back 10%, pulled back 9%. Lots of dips, lots of dips, lots of dips, lots of dips, lots of dips until we had to have a deleveraging. We get out of the deleveraging, became about a 20, 30% correction. We worked our way out of it. Another pullback, another pullback, another pullback, another pullback. That was through 2023 and 2024. Not bad. But another big pullback. So anyway, I think pullbacks would be great. Expected window 4 to 5%. Could it get a little bit nastier? Sure. It could pull back to 5,800, 5,700. But I think below that, we're gonna we'll find some support. And if not, there's something broken. Like something's gonna go wrong if all of a sudden we're like all the way back down here to 5,500, and it's just, well, that was the halfway point the market couldn't find, and we get back to resistance and we sell off again. But I think right now, I'd be curious to see how aggressive the retail crowd positions. If the retail crowd gets a dip right here, are they all in? I mean, I hope they're not. I think that'd be stupid if they're buying this thing on like a 2% correction. But a 5% correction, I'm going to start playing, right? A 5 to 10% correction, I can take trade size, work my way back to the highs, and make that a really nice winning strategy. Have defined risk. So if it does get worse, I still have hedges way out here that pay a lot if I need them. Sam says retracement or crash. I'm saying retracement, right? You tell me crash. Like anytime somebody's like, it's ripping, it's right, it's crazy, it's falling. Let's put it in context. Okay. A crash is we're going here. That to me is a crash. If we're crashing, this market's coming back to retest April lows. That's a crash. Okay. I don't think we're there. I think there is, I mean, as far as like you put a positive and negative right now. Look, I don't think that the market is going to break unless we have something really topple over in consumer or employment. We can say debt, but it's honestly, it doesn't matter. We're going to raise the debt ceiling. We're going to keep printing, like it's going to happen. Housing, maybe. If you start forcing people to take haircuts on their house prices. If you want to sell and you got to trim your sell price by 20, 30%, that's going to sting a little bit with the equity that people think they have in these home prices. And then trying to think, I guess like growth versus debt, and then fiscal and monetary policy. Okay, so on the negative side, like these would all have to, like something's gonna have to break. Either the consumer breaks, the bond market breaks, the dollar breaks, something happens to the consumer, the job market, the housing market. Right now, we have like a pretty aggressive fiscal administration. Like fiscal policy, fiscal spending for the U.S. side is a plus. So I'm going to put fiscal over here. Okay. Monetary policy has been holding and restrictive. And I think if monetary starts to loosen a little bit, then it's going to be more of a plus and a tailwind for the market. Okay. Debt, it's obviously this big elephant that nobody wants to acknowledge. And for years and years and years, it just keeps growing and growing and growing and getting bigger. At some point, it might matter. At some point, it might matter. But if we can actually grow in order to keep the ratios the same, if we have 120% debt to GDP, but we can grow at 7 or 8% versus inflation at 2 to 3%, even 2 to 3 to 4%, we can outpace it. I'm not saying we're going to go to zero debt. I'm not saying that our deficits are going to go, down. It's like maybe we stay at 120 debt to GDP. Maybe we decrease that to 115. Maybe we decrease that to 110. Maybe that gives the market a little bit more breathing room, right? Okay, and the consumer and employment, I mean, we don't have a great labor market as far as like the outlooks. Right now, the U.S. non-farm numbers are producing like we're looking at like 100K a month in job growth. There's always revisions, and those revisions have not been great. And a lot of the jobs that are coming in the service industry, and so it's hospitality, leisure, or it's healthcare, or they're government supported. Make sense? And then the consumer is like, I don't know how the consumer's like making it. I mean, life doesn't seem any cheaper. I think if you own a house and you've seen it go up in price, that feels good. If you've been an investor with a portfolio, whether it's passive managed in a 401k through your company, getting kind of free money with that 401k plan, or you've been participating in the markets at all these last 3 years, 4 years, 10 years, 15 years, things are good. Now, in real numbers, as far as like debasement and loss of purchasing power, it's really an illusion. The S&P goes up 20%, we're probably getting loss of purchase power and debasing about the same amount. I mean, that's the reality. But I think this year the market is starting to head more into the line of like, okay, we got the S&P here. Now compare the S&P not just in dollar terms, but also in gold and also in Bitcoin and also in other assets that might be outpacing the growth of the S&P and the growth of the Nasdaq, or at least keeping up with them, right? So if these don't break, that's my point. If these don't break, then I don't think there's a problem. And it doesn't have to be all of them together. It could be one thing in a big way. I don't know. This has literally been the wall of worry for the last couple of years. I mean, I hate saying cautiously bullish, but it's what I am. It's like I think the market is ignoring a lot of things, and it finds a way to go higher. It's been an impressive resilient recovery since this April low. I thought that what this did show us, if anything, was one of the dumber reflexive rallies we've seen in a long time. Like honestly, I would even say like it was dumber than COVID, because what it felt like this was a self-inflicted flinch by the US. We didn't have to put out tariff numbers that surprised everybody when really Wall Street knew that they were willing to accept about a 10 to 12% tariff globally, right? But what did we come out with? Well, we announced ridiculous numbers all over the place, and the market hated it. And so it was an overreaction that became a reflexive reaction. Okay. So this does seem like look, COVID, the whole world shut down. So that seemed like losing 35% in a 30 to 45 day cycle was a little bit more warranted than just doing some really silly math and saying like, hey, look, we need to have better terms with the world. We're going to change everything. It's like that seemed very self-inflicted. So we still got to all-time highs. So it doesn't really matter. It's now like, what are we doing with it? Are we going to use this to, open up the conversations to trade more? Or are we going to use this to I don't know, screw something up. It really is a huge question mark. And I think if I kind of predict the markets, it's a big question mark with, I think the upside is still going to happen. I think the upside is still going to happen. The market melts up, but it's going to be with some ugly pullbacks. It's going to be with a lot of noise, and I still think that the noise is going to be bought. Like you have a noisy day. It's like, oh my gosh, here it is, and then boom, it's bought, right? But it would just be nice to see not the market not run without having some type of technical obedience. When this is above a 21 period for 60 plus bars, and it's above a 200 plus bar, or point wise, like above a 50 day or above the 200 day by X amount of points, that rarely happens in history. It just means that there's probably a reality check. Okay. Ag saying, let's assume the market will drop 5 to 10%. Would you still sell put spreads on stocks? Yes. Yep. So there's still stocks I'd trade. There's still like individual stocks. There's certainly indexes I would play. Because look, if I want a lower volatility in my portfolio, I'll trade indexes over a stock. An individual stock, unless you're trading something like a low beta, right? If I'm trading something super, super low beta that it has like little to no correlation, I mean, the market could drop 10% and the stock maybe drops, 1%. Great. That's the low, but that's low risk and low reward. There's no way a low beta stock is going to give you crazy amounts of upside potential. But in index also, it's like, look, this market dropped 20% peak to trough. We had individual stocks. I mean, the MAGs, that ETF that represents MAG 7, that was down 30+%. Individual stocks dropped 30, 40, 50%. We had some massive corrections on individual stocks. But this market also ripped back up about 30+%. And meanwhile, we have seen AVGO and Nvidia and Microsoft and all these other stocks that have ripped back and also stretched out to 80, 90, 100+%. So it goes both ways. If I want less risk and I'm willing to play more indexes over individual stocks, that's fine, because what am I doing? I'm talking about trading indexes so I can eliminate some of the volatility in my portfolio. I realize that eliminating some of the volatility in my portfolio is going to also sacrifice some of my upside gains. But I like steady. I like steady gains. I don't like surprises. I don't want super volatility. And also, I'm gonna find a study. I know it's out there. I've seen this in a bunch of different like financial reports and podcasts that I've listened to. But basically, if you're a stock picker, you have a borrowed time window, because over time, everything that's good will change the top 10 stocks. There's always a rotation into what's good, what's not. This kind of anomaly we've had, it's like Mag 7's been an amazing bellwether for the S&P 500. It's been an amazing performer for the Nasdaq. It has been probably one of the coolest baskets to trade for the last decade, because if all you did was held what initially was FANG, if you held FANG stocks, and then you added FANG Man, and then you added FANG T-Man when Tesla came on board, and all of a sudden now you're talking Mag 7. And now you throw in maybe AVGO because it's a semiconductor play, right? Broadcom. I mean, you've got 7 or 8 stocks that if you just maintain that basket for the last decade, it has done extremely well, right? But we're at like almost a pivot point where the market is looking at non-Mag 7 holdings. It's looking at what else can we rotate into. Mag 7 at 30 to 35% of the market cap. Like, that concentration in all Mag 7 is insane, which is what led to this first pullback in 2025. This pullback started with the Mag 7 rotation that then was accelerated and exacerbated by, a tariff/trade war, right? So Mags, I talked about this in my profit panel session earlier today. Mags is sitting here just off of these all-time highs. So this represents the 7. Now, this year it's been interesting that, look, even though not every Mag 7 performer has been killing it, what has this thing done to recover? Well, from peak to trough, this thing was down about 33.7%. And then the performance on the way back, since we're nearly back to the same highs again, this has performed to about 50% of the upside. So yes, the index on the S&P was down 20%, but then rallied 32%. This fell 34%, rallied up 50%. It's a reflexive rally. So what I'm saying is, it hasn't been led by all Mag 7 stocks. Apple is underperforming. Tesla's underperforming, right? This has been driven primarily by Meta, Microsoft, and Nvidia. Those three stocks have carried this Mag 7 to recovery highs or close to all-time highs again. So do I say that we don't need Apple anymore? Do we not need Google anymore? How about Amazon? I mean, we still need them. It's like technically they're still a Mag 7, right? But what's nice is the weighting on something like this is still benefiting from, you can just have this one asset that's representing 7 really great companies. Okay. And it's enough to have, if you're willing to buy the dip, like you buy the dip and you're seeing some profit. So, I mean, I bought the mags back at like $42. I took profit at 52. I thought that was a good trade. I bought the S&P at 496 and took profit at 586. I thought that was a good trade. I bought the Qs at 410, took profit at 500. I thought that was a good trade. And you can see that I've still sacrificed some upside, right? I sold the Qs at 510, they're at 568. I sold the SPY at 580, it's at 636. Mags I sold at 50 something, 50, I think 42 to 52, it's up to 58. So I've definitely given back some profit, or just not trailed it enough. Like I guess the trailing stop loss would have helped, but I thought good enough, taking some profit. It's a nice recovery. I just thought we'd have more of a pullback, which is why I keep saying this. I think we just have to have a pullback. It's nothing wild, it's nothing crazy. 5 to 10%. And that's, again, I'm trying to be very specific because I know it's easy to be like, yeah, 5 to 10% correction. Look, be realistic. I mean, a pullback to this average, a pullback to this moving average, that's about 2%. This is about 5%. Okay. Be aware of those numbers. Be aware of those numbers, because 2 to 5% is enough of a dip to possibly justify buying that dip. Okay. It's enough of a pullback that if this market's going to be bullish and bullish and bullish and bullish, stay with it. Right. Does the structure break? I mean, to me, if we're down below 5,700, it's definitely more of a cautious tone, where maybe this market gives us a broadening pattern. And that's not going to make anybody happy. If we come all the way back down to April lows, I am buying April lows. I don't know if those April lows come all the way back up to highs again, or if they come back to the halfway point, but I will be positioning for profit opportunities at these lows. And if I start at 20% of a discount and I can take it down to 25 or 30 or deeper, I will hold positions, because when we come out of it, and I believe that we will, and I think you're silly to think that we won't, right? If you are that bearish in these markets, if you want the global economy to fail, then you probably shouldn't be a trader or investor. You should probably go into cash, get yourself out of debt, and go live off the grid somewhere, and have a farm, store a bunch of batteries, be a doomsday prepper, and not worry about the world other than what's in front of you. Like, investment and trading the markets, it's a completely disconnected reality, right? Like, this does not represent the economy. And we saw that it was exploited in 2020, when it's like, wow, everyone just got laid off, / nobody's going to work anymore. No offices are open. Everything's changing. The whole world changed. And in 60 days, the market's like, we're back to all-time highs. Like, that's not reality. And that was the K-shaped recovery, where the assets said, well, we figured it out. We're going back. We're getting out of COVID. We're fast tracking these vaccines, blah, 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 back to normal, business as usual. And the markets were way more reflexive, right? People 5 years ago to people now, it hasn't been easy. Like, humans, consumers, employment, workers, it hasn't been the same reflexive, right? Because we're still dealing with, like, life is more expensive. Things have gotten a little bit more disruptive and frictional the last 5 years. There's been opportunities, but the opportunity is like, if you're an investor, yeah, it's been great, right? If you're not an investor, life's different, and it hasn't been any better. And we're like promising things are going to get better, better, better. Look, I don't know what's going to get better right now. If Trump can somehow pass a zero capital gains tax on real estate, cool. But who does that benefit? Not a millions of renters, right? It benefits people that own houses, And I mean, if it's enticing them to sell homes, okay, cool. You sell houses with zero gains, but then what are you doing? Are you buying homes at this unaffordable housing market high? It's like there's always a trade-off. So anyway, it's easy to just get in the weeds of like how bad things are or feel, when the reality is, just look at the charts. I'm this, like, this, me saying there's going to be a technical correction is exactly that. I'm not bearish. I'm not painting this picture of like this and this and this and this and this. Look, all these things stack up to be like, yeah, the market should probably have a little bit of a check, like a reality check. But the priority of the market right now is, if dips are getting bought and there's flows coming in and there's buybacks and there's fiscal policy and there's more accommodative monetary policy on the horizon, and yields aren't blowing up and making things more difficult, I mean, the markets can adjust to rising rates. The markets can adjust to rising inflation. What they can adjust to is a blow up in rates or a blow up in inflation. That's why the basis trade that happened back in April was so disruptive. It was a shock to the system, right? And every time we have a shock in the system, the market usually has a bunch of casualties, and then there's clear winners and losers. And these opportunities will continue to happen over and over and over again. And I'd say the one challenge to anybody out there that is trading, whether you're brand new or you've been in this market for a long time, anybody that's trying to trade, for passive income, replacement income, full-time, whatever you want, the market will give you plenty of opportunities. It really will. And those opportunities every year, I mean, seriously, like, hindsight is never a real thing. Like, I never want to sit and be like, oh, I should have done this. That's not trading. But you can see that if you had cash available to invest at a discount this year, you've been rewarded very well. If you had cash available to invest after the pullback in 2024 from July to August, you got paid really well. If you had the cash available to trade in 2022 with the 30% correction in the markets, you got paid very, very well. If you had the cash on the sidelines to get a nice discount here during 2020, you got paid very, very well. Those cycles will continue to happen, and look, it's not for everybody, but I know that if I had my money tied up in a fund that was fully allocated all the time, that would make it really annoying to see that my watermark high is right here. The market crashes 30% and my watermark is now down with it. As opposed to if I'm, let's say, 50% invested, 60% invested, maybe 70%, 75% max invested, I still have cash to deploy. And that cash deploy, strategically, tactically. But if it's deployed and then I get the reflexive bounce, that 25% is now helping generate a nice extra chunk. And yes, I can recover from the initial investment, right? I can get the money back, but like dollar cost averaging maybe moves my cost basis down a little bit, and I can get on top of that by the time we get to those highs again. So look, I think the market has all of the potential to give us, 7,000, maybe 10,000, but it's going to be when? A couple years away? 7,000 might be this year. It might be. Okay. 8,000, 9,000, 10,000, we probably get there after another crash, right? Like 20+%, that was a crash. That was a crash. It could have been way worse. But getting to 8, 9, 10,000, it's like if we get there after another big pullback, or we get there first before we have a pullback, there's going to be another point where, I'll turn more into a bear, right? But I'm going to turn into a bear with defined risk. So define risk, define risk, define risk. No one trade, no one win, no one loss is a reason that you can or can't trade. Stay in the game, right? Markets give us countless opportunities. Stay in the game. I think you'll do well. But risk management first. I think that's the most important thing. You manage risk. Don't do things silly. Don't over leverage. Know there's going to be opportunities. The hardest part, I'll leave you with this today. The hardest part for me these last couple of months has been watching this account, melt up to highs, and knowing that I'm not actively participating as much as I was back in April and in May. Like, I was really aggressive through the dips in March and April, came out of those really profitable through May and June. But now it's been like, okay, so now what do I do? I've turned way more to income trading. I've turned more to doing some boring transactional trading where it's like, yeah, I'm just going to try to take 10 trades and make $100 and there's an extra $1,000 and do that, 50 more times. I'll make some more money. But I think if we have a dip or pullback, then I've got cash at the ready that I want to deploy. I am still just under 50% cash, just under. I've allocated, but 3.9 to 1.8. Okay, I'm just under 50% cash. But I think that's enough to also have at the ready. If I need it, it's there. And there'll be plenty of active trading ahead. So that's what I'm excited about. That's what I'm kind of looking at some of the technical levels to dip and pull back to, because there's deployments that I want to participate in. Right? It doesn't have to be challenging. I mean, services I have, we'll talk through these. It's like daily profit play. We trade every single day. We're going to be in the trenches every single day. Cool. That's what I'm here to do. Waterfall income, we're going to be in the trenches every single week. We took 2 trades today on waterfall income. I'm actually pretty excited about. We have 5 or 6 open positions. I'm totally happy with them. Okay, newsbreakers. I'm being a little bit cautious on newsbreakers right now. I'm trying to fade some earnings pops if we get them. But I'm going to accept the only way I'm going to get filled is I'm getting more credit on the reward side than the risk side. Double ups, because we are in a summer lull, it's been very difficult to get an outlier that I usually trade. So I've been a little slow on the double up service the last couple of weeks. I think, I don't know if it was FOMC minutes. There was something like 1 or 2 weeks ago. I think it was 2 weeks ago. I traded an upside and downside. I ended up winning 132% on one side and then lost 100% on the other side. So I netted 30%. That was fine. Actually, double up might be good this week because we have FOMC plus we have the expirations on Friday. So I could probably find some levels that would be pretty key to watch with the potential volatility we have this week. Pinch point continues to be finding great trades. Really, really good. I mean, I think we've had 13 or 14 winners so far, 2 losses. The winners have all been hitting, our 30, 40, 50% take profits. They're just, the scanner finds them for me and I just price them out, make sure that I'm getting a good price, take the trades, and I don't worry about them. Price target's already set. Okay, crash insurance. We talked about this last week. I did add some insurance. I did add a micro S&P futures trade on MES. Some people said I don't trade futures. Well, you can trade XSP if you want to take something similar. It was roughly about a 10-to-1 setup. So I can risk, my trade, I'm risking about $250 to make $2,500. For XSP, it would have been roughly about $500 to make $5,000. So roughly 10-to-1. Okay, Project Options Edge, we had a great week last week. I think we closed out for 4 winners and took a couple extra trades. We're continuing to knock out just like winner, winner, winner. So more income trading there and a little bit more advanced, a little bit more capital intensive. But honestly, it's the way I like to trade. I don't want to be tied to Chris only trades one way. I mean, I want the creativity. I want to be able to trade the market up, down, sideways, and I can't do that by just one strategy. I can't just buy calls and trade the market up, down, sideways. Unless I'm really patient in between. So I like trading lots of options. I like trading lots of spreads. And anyone that's in my classes, I think I'm going to go out on a limb here and say anybody that's in my classes, I have probably opened up their mind to trading more ways than one, right? So if you come to me with I just buy calls, I just buy puts, that's fine. I think you could be better. I think you could trade a little bit more tactfully. I think you could trade a little bit more with define your risk and give yourself a higher probability. Not have to get in early and manage so quickly when it's look, I can let trades go to expiration. I can let price do what it needs to do. I can know that if the market goes up, way above my levels or way down below my levels, I'm either risking what I set up or I'm making profit on what I set up. It's okay. Just take more trades. Risk defined where I cap the downside, most importantly, cap the downside and also cap the upside. Fine. Just take more trades. Okay. All right. Anyway, so that's good stuff. If you're interested, I've got a lot of trades in my service. You're watching this on the Financial Wars. You're watching this on my YouTube channel. If you're interested in any of these, you can reach out to the team at Prosperity Pub and inquire. So any courses, I'm running a daily room every single day now. If you'd like to join me every day, I'm trading every day. I'm now pushing this on a Zoom channel as well as my youtube.com/financial wars. I'm pushing out through Prosperity Pub's YouTube channel. So if you'd like to join me for free every day, you can. We'll talk shop. Macro Monday, Technical Tuesday, Watchlist Wednesday, Training Thursdays, Fast Money Fridays. It's just a theme. If you want to bring some ideas to me, hey, Chris, I'd like you to talk about this. I've talked about these. We're going to talk about all these lessons. I do them every single day. Some of these are going to be classic, revolving lessons where we just keep reviewing them with new live examples, or we keep adding to the list of lessons, right? All right. So anyway, just a little info for you. If you'd like to join me for tomorrow's session, I'll be live tomorrow morning at 9 a.m. Eastern time. Here's my Telegram. Okay, so Telegram, Chris Pulver, Telegram. Okay, there's a link in there. And if you'd like to join my Discord, I'm going to give you a 30-minute link for Discord. 30 invite. Let's go edit. Good for 30 minutes. And then Chris Pulver Trading, Discord. Okay, if you're in my Discord channel, please read the rules. I don't send friend requests. I don't send direct messages. I will respond to you if you contact me, but I'm in the public channels every single day on my Discord. It's not a complicated Discord. It's really just a place for me to put all my content. You want to talk stock, you want to talk with everybody in the community, talk Forex, talk stocks, talk options, talk futures. Anytime I'm live on YouTube, it pops up. Anytime I post a video or analysis for TradingView or anywhere else, it pops up. You want to contact me for private instruction, working with one person or I'll work with up to a group of 10. Where there's discussions there, but you can reach me anytime on Discord. Telegram, this is my primary channel where I'm posting probably 90+% of this content is me. I don't do all the marketing stuff, but I do, this. I do this. Anyway, most of it's me. And then from the services I run, each channel that I run and manage, Project Options Edge, Pinch Point, Daily Profit Play, and the list goes on. And then we have trackers for all the services. All the trades I take are all live trades. Okay, I don't trade demo accounts. It's real trading. My money's on the line. I don't take a trade I don't think I can win, or else I wouldn't place a trade. So it's real money. All right, I will let you go for today. Let's come back and do it again tomorrow. We'll grind out 9 o'clock. We'll start. We got a busy week this week. I just want to plant the seeds here. Just some of the schedule stuff. So this week we have 790 companies reporting earnings. I think the big ones to watch, in my opinion, is going to be the Mag 7 and a couple more. So Apple, Apple, Amazon, Meta, Microsoft. You also have MicroStrategy. You have Coinbase. Those are some big ones this week. Okay, there's 790. There's a lot to choose from, but I'm watching a handful, and I'm going to try to find some trades. And we also have FOMC on Wednesday at 2 p.m. I'm actually running. I'm paneling on a trading battle. Where it'll be me versus Akil Stokes. We'll be trading against each other. Nick Sayek is hosting. It should be like a 1 p.m. I think it's a 1 p.m. or 1:30 p.m. Eastern time start. And we'll trade through FOMC together. Okay, we might do it at like 2 o'clock, or we might do it at 1:30. I think it's gonna be a little prep beforehand. I think it'd be chaos if we went right in at 2 o'clock when the market's gonna react to FOMC. So we probably jump in a little bit early, get some prep, talk about what we're looking to trade, and then we'll handle the markets and the close. We get the trade to the end of the week. What else? We have Friday, so this is for the week, right? So this week we have companies reporting, FOMC on Wednesday, and then we have non-farm payroll, right? Non-farm payroll, so U.S. jobs will be on Friday at 8:30 a.m. Eastern time. Okay, and have the August 1 trade deadline, which I think is less impactful now. Right. I say that because, we have Japan that's already been talking through doing some deals with the U.S. We have the Eurozone that hit today. China is still a big maybe. Like, what official deals do we have with China? I don't know. It's probably going to be more pausing, more negotiations back and forth that we don't really hear about. But at least it's not like just like a Cold War, like no more trade with China. It's not going to be like that. But Japan, Eurozone, like big allies, are now kind of getting in line with this deadline. So that's encouraging. Markets, I think, have melted up because of that. The ceasefire / the Middle East conflict is toned down a little bit. So I think that was another catalyst that the market was able to kind of surge on. And I just think it's less impactful. That's kind of my summary. Less impactful, right? But August, September. I mean, you have most of August. The markets are usually not bullish in August. The markets are usually sideways in August. September is usually a bearish month, and there is a technical pullback that I keep looking for that I think will get one. And I don't know the why. I don't know why. It doesn't matter, because why the market pulls back 5% is because I'm looking at the charts, right? I don't know exactly what headline is going to tie to the market and say, well, that's why the market fell. Who cares? I'm telling you right now, before it's even happened, we're probably going to pull back 5 to 10%. I just don't know what the catalyst is going to be. I don't care. Something's going to happen. And I'm hoping that whatever the catalyst is not enough to then change the tone and structure of the market. It's just enough to offer that pullback, allow some positioning, ventilate the VIX a little bit and some volatility, and then give money a chance to participate. Give money a chance to participate, not at all-time highs, but rather a little bit of a pullback. And then we can resume all-time highs. PC on Thursday. Oh, good point. Yeah, that's a great point. I forgot about that one, actually. That just hasn't been, it's been like kind of a non-impactful news event. But you've got, good point. So core PCE and headline PCE on Thursday. So end of month. Yeah, and that's one to not ignore, especially when it comes to the Fed's decision on Wednesday. In fact, I think it's interesting that they have the FOMC on Wednesday, and then literally the next day PC comes out, because that's their kind of preferred inflation measure, right? So yeah, there's a lot. That's a lot going on this week. It's a really volatile week. We wrap up the month. We start a new month. Kick off non-farm payroll. Um, I think the volatility would be even more so if we didn't have a little bit more clarity on the trade deadline. But now I think that's like, meh, it's not as critical, in my opinion, unless August 1st comes out and Trump's like, you know what, we're not happy, we're doing this. It's like, I don't think he's going to do that. He pivoted very hard in April. I think he is going to continue to, walk that. Like, if anything, the noise that Trump creates is going to be more on what he's doing with the Fed. He wants to see lower interest rates. He's trying to say, like, let's make it cheaper for the American household to own. Let's make it cheaper for the American worker to own a house. It's like, we have work to do. There's a mounting debt. We have unaffordable living conditions, I think, for a lot of places. I just read an article today. 10 of the most extremely unaffordable housing markets in the world, 5 of them are in the U.S. That's not a good thing, right? And I would imagine elsewhere, it's like, where are we going? We going like Shanghai, Hong Kong? We going to London? We going to Paris? We going to freaking Singapore? Like, what other housing markets are super unaffordable? But in the U.S., I mean, name your city. Things are pretty bad a lot of places. So anyway, a lot of stuff. But guess what? We'll tackle it head on. We'll be the buffalo run into the storm, and let's make some good trades this week. Okay, thanks. I'll see y'all tomorrow. Join me live 9 a.m. Eastern time. Daily profit plan. I'll see you in the morning. Thanks. Bye.